This is Matthew Cratter from Trader University, and today I want to talk about the fate of the U.S. housing market. I've been getting a lot of questions about real estate, single-family homes in the U.S. I can't really talk about other countries, I'm not as qualified, but I do understand the U.S. real estate market quite well as a long-time real estate investor. We're going to take a little detour in order to understand this, so bear with me. I think it will definitely be worth your time. We're going to turn to Zimbabwe, which has really been one of the worst run countries in the history of the world. The amount of corruption, the amount of poor governance is hard to imagine. This is a country that's actually now allowing people, they're selling off the right to shoot elephants in order to fund their national parks. And as a lot of people know, there's been hyperinflation. This is what a typical paper money looks like, $100 trillion. I imagine this buys you a loaf of bread or something like this. So this is an example of a central bank that's much worse than even the Federal Reserve. So when you see this constellation of facts, if you don't know that much about economics, you'd be tempted to think, wow, their stock market must really be in bad shape. You wouldn't realize, as we talked about yesterday, that the stock market's actually up 1,000% in 2021. This is a chart of it over the past, call it the past 6 months or the past year. Now, the counterintuitive thing about this is that you would expect it to be down. It's up a lot, but the real reason for this is, of course, because the unit of account, the currency, has devalued so much that even if you were long the stock market, you still lost money because you were holding Zimbabwe dollars. And the dollar went down, the Zimbabwe dollar went down more than the stock market went up. And I think we're seeing something very similar actually happening in the US. I talked about it a little bit yesterday where I borrowed this tweet to demonstrate how if you adjust the S&P 500 for the growth of the Fed's balance sheet, sort of a form of base money or part of base money, you'd see that the stock market has really gone nowhere in these real terms since 2008. 2008 is right around here. And what we have here is we have an economy that's basically running on sugar or caffeine. One of my commenters, Tim Barnes here, talked about what if we adjusted the housing market for the Fed balance sheet? And I think this was a really good question, So that's what we're going to do as a way of talking about the U.S. real estate market. Anyone who's been following the major metro markets in the U.S. knows that they're up quite a bit. In spite of the pandemic, in spite of all the bad news, LA, for example, is up almost 10%. If we look at a long-term chart, we can see it's really straight up. Likewise for Denver up about 8%. The chart looks very similar. Seattle up 8%, very similar multi-year chart. Austin, places like this that are really benefiting from people moving out of California, up 16% over the last year. Now, this is in a context where the Fed says that there's still no inflation. Now, there's no inflation in those things that you don't want to buy, but if you need to pay for university tuition, housing, medical costs, these all things that people really need have very high inflation. And so the Fed is being very disingenuous here by using CPI inflation, which doesn't really incorporate these sort of there is a real estate component, but it's been so watered down and adjusted that it doesn't really come through. Let me pause here before I go on to ask you, if you're finding this video helpful or interesting, to hit that subscribe and like button and maybe share the video with a couple friends. So the Fed says there's no inflation. If we look at what houses are made out of, for example, lumber here, if you think of the framing of a house, lumber has been skyrocketing. A lot of people attributing these to supply chain problems that have been in existence since the pandemic began. But the problem with this is you're seeing this sort of inflation everywhere. Just Coca-Cola Company announced this morning that they're going to be raising prices, etc. The inflation seems to be everywhere, except in the government statistics, like the CPI. If we look at the National Home Price Index, this looks at all the major markets, and we can see that it's really been it's been straight up since the great financial crisis. It's been a little bit wiggly, but we can see how the slope has really increased over just the past year. And so this is what we were seeing in these individual markets as well. But what happens if we do follow Tim Barnes's advice and we adjust this for the Fed balance sheet growth? I think it's a really interesting suggestion. I'm on the Fred site here. This is one of the central bank sites for the U.S. for economic data. Very, very helpful. What you can do is you can click here on Edit Graph, and you can add 2 different time series, and then you can divide one by the other. So what I've done here is I've taken this same chart here of the National Home Price Index. I've adjusted it for the central bank balance sheet growth, and we see something very, very similar. We see that housing prices are actually lower in central bank, in Fed balance sheet terms than they were at the bottom of the 2008-2009 great financial crisis. So what this shows is that the unit of account, we've had so much money supply growth, we've had so much stimulus from the central bank, and this is what's really driving housing prices. And when you adjust for this, you see that housing prices have actually been falling for the past, call it the past 15 years. Housing prices never recovered in real terms after the 2008-2009 crisis. They've recovered obviously in nominal terms, and they're at new highs. The real key to doing this is you don't want to do a CPI inflation adjustment. You want to adjust for money supply growth or growth of the central bank balance sheet. That's a much more honest way of doing it, because everyone knows that inflation is not currently at 1 or 2%. This is what it looks like living in the fake clown world of central banking. And people who say that there's a stock market bubble don't understand that what we're looking at in the U.S. is something very similar to Zimbabwe. Now, obviously, the U.S. dollar is a much stronger, much more well-run currency. It's a global reserve currency, which really helps. The Zimbabwe dollar was never a global reserve currency. But we're seeing very, very similar dynamics. No one would say that the Zimbabwe stock market's in a bubble, because everyone knows that it's not that asset prices are going up in Zimbabwe. It's just that the value of the currency is falling. And this is what we're seeing as well with asset prices in the U.S. It's not that there's a stock market bubble or a real estate bubble, but what we're seeing is a U.S. dollar collapse versus real assets. And it's completely driven by central banker policy. Your house is basically the same house that it was in 2008. Maybe you have some you've converted it to a smart house and you have some automation, but the basic value of the house in terms of the land and the location, etc., and you have ongoing maintenance costs as well, the house is basically worth the same as it was in 2008. But because we live in clown world, housing has become much more expensive. And what's really unfair about this is it really helps people who are already wealthy, and it helps older generations. It's better for Gen X and boomers who already own houses, most of whom already own houses and some stocks, versus millennials and Gen Z who are still trying to accumulate these assets. So central bank policy is very, very unfair. It exacerbates wealth inequality. It's one of the main drivers of wealth inequality. Now, I'm very bullish on U.S. real estate, at least in nominal terms, because these dynamics are never going to be able to reverse in our lifetime, at least not for the next couple decades. If we look at where U.S. tax revenue is, it's at about $3.4 trillion. U.S. spending, even before the latest, the coming Biden infrastructure bill, U.S. Federal spending is at 7.7, call it $8 trillion. And so you have this deficit where the U.S. government's spending more than it's bringing in order to make up that difference. And we should say there's no way to ever cut this budget, because you can't cut Medicare, Medicaid, you can't cut Social Security, you can't stop spending on war and defense. You could, but if you're the world's global superpower and you have the global reserve currency, you do need to keep the shipping channels open, etc. And so this really can't be cut. And we also cannot default on our debt. That would bring down the global financial system. So the only solution really is for the central bank, for the federal government to issue debt to make up this difference. Just like a household, if you're spending more than you're bringing in, it means you need to borrow money. The U.S. federal government needs to borrow about $4.2 trillion every year, and counting. This number is going to accelerate as all of these unfunded entitlement obligations roll on. And so the Fed's going to need to continue to increase the money supply, print money, and use that money to buy U.S. Treasuries, and thus make up the budget shortfall. What this means is that stock prices will continue to go up, real estate prices will continue to go up, and the most reliable and honest thermometer in the room, which is of course Bitcoin, cannot be manipulated and has a fixed supply of 21 million. Bitcoin prices will go up more than anything else. Combined with this, we're seeing very low home inventory numbers. We can see here that existing home inventories are much lower than they were even 5 years ago. Obviously, housing is a supply and demand market. Low inventory and high demand will be led by increasing supply. And so there will be, the U.S. home builders are doing very well, etc. This inventory will eventually be brought back up. Though to a certain extent, a lot of markets like California that are already all built up, and there are a lot of environmental restrictions, and you have sort of an enforced scarcity, they will behave similar to Bitcoin, where there is some scarcity. Compare that or contrast that with parts of the U.S., maybe like the Midwest, where there's more land and there's less of a supply shortage. You can basically, if you look at the plains, if you look at the country east of the Front Range, east of the Rocky Mountains, there's a lot of flat land you can build. You can really build to infinity. And so if you do own real estate, you want to own it in areas that have enforced scarcity. Probably better and easier just to own Bitcoin. But I guess the next question that people would ask me is, well, what about the wave of foreclosures that's coming? This is an article from October of 2020 saying, well, the housing market's doing really well now, but what's going to happen when all these plans, the mortgage forbearance plans, which allow you to defer paying your mortgage, what's going to happen when they all expire in the spring of 2021? Well, we know what happened, and it's not surprising, given that we now live in a fairly socialist country, that there is an extension of this forbearance. Maybe it's a good thing to do. There are a lot of people who've lost their jobs due to the lockdowns, etc. So I'm not going to really, maybe calling this socialist is too harsh. That being said, we did see that all of this is being extended through the end of June, through June 30th of 2021. And then, of course, once we get there, they call it extend and pretend. This is how the U.S. financial system has been working for a very long time. And this is merciful to homeowners who need it. But again, this is not something that I'm worried about at all. The underlying dynamic is that there will be continued support. There'll be continued stimulus checks. These stimulus checks are, of course, all paid for by Fed money printing. And so you have this strange situation where people who don't own their homes or are not as wealthy, don't own as many assets, will continue to fall behind as the Fed prints more and more money, driving up real estate prices, requiring more and more stimulus to help the people who are falling behind. And it's really, really a vicious circle that leads to increasing wealth inequality, social unrest. And I don't think we're going to look anything like Zimbabwe anytime soon. But I do think that the real estate chart and the stock charts in the U.S. will look like Zimbabwe, not because the economy is great, but because we've moved to a much more centralized economy where everything depends on the Federal Reserve. If the Federal Reserve decides to raise rates and pull back on the stimulus, what you'll get is a deflationary spiral, stock crashing, asset prices crashing stock and real estate prices. And the Fed, of course, will panic and continue restart their stimulus. So we could see volatility. Obviously, the volatility shows up instantly in the stock market. Real estate prices are a little bit more opaque. You don't get real-time quotes every 5 seconds. But the problem is there are only two ways out. There's the deflationary spiral way out, which will cause huge rioting. People will be starving. Companies will go out of business. Or you have the inflationary route. And anyone who tells you that we're going to see a huge dollar rally, that we're going to see deflation spiraling out of control, has no idea what's going on. We are in an inflationary environment that will eventually lead to a hyperinflationary environment. It's the only politically sound thing to do. It's not the right thing to do, but it's when you've been living this long as a drug addict, dependent on central bank stimulus, there's no way to wean yourself off of it. There's no way for the highly leveraged U.S. financial system to wean itself off of this. And as such, this is going to follow the logical conclusion that world reserve currencies always follow. We're going to see continued devaluation of the dollar versus real assets, and eventually the transition to a new world reserve currency, whether it's a basket of currencies, whether it's yuan, renminbi, or whether it is a Bitcoin standard, remains to be seen. I'm not going to be able to make a video tomorrow. Should have another video up by Thursday afternoon. If you found this video helpful, be sure to hit that subscribe and like button. Hit the notification bell if you want to be notified when I publish my next video. And let me know your questions and comments in the comment section below. Thanks a lot for watching, and I'll see you guys in a couple days.